Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a Loonie in any of these financial markets.
Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. This week we're going to talk about the latest CPI release and why the Bank of Canada faces an impossible choice. Continue to cut interest rates to save a slowing economy, risking higher inflation, or fight inflation and push Canada into a deep recession. Neither outcome is good, so let's get right into it. As usual, this week's video will be split into a couple of sections. We'll talk about inflation first, and then talk about its implications for the BOC. The Consumer Price Index, CPI, rose 2% on a year-over-year basis in October, up from 1.6% in September. The month-on-month increase was more than the 0.3% the market was expecting and brings us back up to the BOC's inflation target control range of 2%, plus or minus 1%. I'll reiterate, however, that prices are still rising, but just at a slower rate. For a lot of families out there, it's the level of prices that matters, and that's why I always include the price level, the light red line, in this chart. Next, a quick look at the major components. The monthly rise in headline inflation was due to a broad-based increase in each of the major subcategories of the CPI basket. At the top, you can see clothing and footwear jumped by 2.4%. That's a lot. Shelter also jumped, which is of note because it is against the recent trend and the biggest monthly jump in a year. What also stood out to me was that for the first time in more than a year, all components were up on a monthly basis. A look at the split between goods and services is always important. Here we see that the prices for goods jumped a lot from September and is back into positive territory on a year-over-year basis. In contrast, the prices for services continued to decelerate in October, but they are still rising at 3.6%, which is above the target range, although this is the smallest increase since January 2022. Finally, we'll end the recap of the CPI release with the BOC's three preferred measures of core inflation. And here again, we have something interesting to flag. All three measures rose on a year-over-year basis. And as a reminder, these three indices are designed to exclude transitory items, that is to say, exclude the most volatile parts of your consumption basket. And although I'll stress again that one data point does not make a trend, this is definitely something to keep an eye on. So why is the BOC in a pickle? The BOC wants lower rates. We have argued that Canada is already in a per capita recession. It has been almost 2 years that Canada's GDP per capita has been falling. And this is in part because household debt service ratios are at an all-time high and are crushing consumption. You might also be aware that many Canadian households are facing a refinancing wall. Much of the borrowing done over the pandemic is now up for renewal, and mortgage rates are much higher than when the BOC cajoled Canadians into borrowing and speculating on the housing market with the insistence that rates would be low for a very long time. But one more reason is that the federal government made the same mistake that households did. Instead of borrowing the $400 or so billion for COVID at the long end of the curve, meaning with long-term fixed rates of 10 years or more, when interest rates were at record lows, most of the debt was issued at the short end, 2 to 5 years. This debt is now maturing and must be rolled over or reissued, but at much higher interest rates. This will push up interest payments, as we are seeing in this chart, and this doesn't even take into account the growing budget deficits, which will be the topic of another video. So how does this relate to the Loonie? Inflation falling allowed the BOC to cut interest rates aggressively to mitigate weaker growth and the higher interest payments. The trade-off here was a much weaker Loonie, and this chart shows exactly that. As the US and Canadian economies diverged, so did the expectations for interest rates, shown here as the spread between the 2-year government bond yield of US and Canada, the red line, which is now at a 25-year low. A weaker Loonie, all things being equal, is better for growth, problem solved. But to quote Scottish poet Robert Burns, the best laid plans of mice and men often go awry. There is no free lunch. This is because a weaker currency flows through to higher import prices, and with no productivity to push back against that higher inflation, prices can start rising again. Indeed, inflation is looking increasingly sticky, and our IceCap inflation model suggests we might even get a rebound. Furthermore, according to Stats Canada, one of the main drags on headline inflation over the last couple of years has been the normalization of energy prices. Energy is only 7% of the CPI basket, but the huge moves meant that it has an enormous impact on overall inflation. Most of that is over, as you can see from the chart. The worry is that energy prices might move higher, either because of supply issues, global conflict, and yes, even higher taxes. Again, this may prop up inflation, further complicating the BOC's job. Fight inflation and risk a recession, or let the economy run hot for better growth. Again here, the problem, as I've said before, is inflation disproportionately hurts working class people as they don't own assets that can protect their purchasing power in real terms. Inflation is not benign, as we've seen, but perhaps the most pernicious of economic phenomena. Finally, to bring it home, housing, or more accurately, mortgage rates. Higher inflation should pour cold water on the view that mortgage rates will fall back to pandemic lows. In fact, the bond market is already telling us this. Despite all the cuts, the 5-year bond yield, the rate many mortgages are priced off of, is rising. Canadians expecting much lower mortgage rates are going to be disappointed. So that's a wrap on this week's episode. Thank you very much for listening. Please like, subscribe, and follow for more. And as always, feel free to get in touch. I'll see you next week.